All right. Welcome everyone to the February edition of the Altos Research webinar. We're looking at what's going on in the real estate market, all the real-time analytics. We're going to cover today all the bullish indicators for the year, which will probably come as no surprise to you. But we're also spending a lot of time on the inventory crisis that we're in. We're in unprecedented territory. Got a lot of data to show you what that means, and also spend some time on how you can communicate that with your clients, buyers and sellers in the real estate market to understand how they should act. Should they buy? Should they sell? What should we do? A little housekeeping before we do have a couple of Altos team on the webinar with us. In the chat window, there is a little chat box. If you have questions along the way, feel free to drop them in there. Use that chat box. When we talk about, I'll sometimes reference some things from Altos along the way, or links that you can go to. You can use that chat box. You'll see the team will post the links in there so that you can click through and get whatever we're talking about along the way. So use that as we're going. We'll try to answer questions on the fly. So as we are going, I have a lot of data, and I won't necessarily be able to get all of them, but the team will try to get them in the chat as we get rolling. So that being said, welcome. We have an inventory crisis on our hands, so let's dive into the data and take a look at what we're really facing. Actually, before I dive into the data, if you are not yet familiar, if you haven't yet downloaded, I highly recommend you do. We have an ebook, how to use market data in your real estate business. We produce this because we talk a lot about the data. We have a lot of clients that use the data and using it with end home buyers and sellers or investors or funds. And sometimes it's hard to know what the data means, or which one should I look at, or what are some scripts that I should use when I'm talking to my clients. Those are all captured in the ebook. So if you are a real estate professional and you're working with buyers and sellers in this market right now, it's so crazy, you should use the ebook, and it's free. Go get it. Use the data. It works with all kinds of data. It's obviously designed with Altos reports, but the scripts will work in any context you want. So go grab that data. Go grab that ebook now, and let's dive into some data. In general, what we're going to do today, we're talking about the inventory crisis, what's happening right now, what the data is right now, but also what's happening next, where we're going from here. The big question on everyone's mind is, are we going to be able to get any inventory? And how do we talk to customers about this crazy market? I've been getting more and more calls from friends and colleagues and people who are trying to figure out what to do. I want to buy, but can I? So we're going to spend a little bit of time talking about that. There are some latest development in the forbearance process that we'll see what happens there. So we'll visit some of that. And then, if you've paid attention to some of our video work over the past year, we've talked about the Zoom towns, these co-primary homes where people are buying, maybe moving out of the big cities and buying for remote work in places like Bend, Oregon, or Palm Springs, or Cape Cod. And we've seen the real boom in demand and pricing in those towns. We've called those the Zoom towns. But what we're looking at right now is the boom is happening. The demand boom is happening in tight supply everywhere in the country, all price points. It's the everywhere boom. And so it's not just the remote work towns. So you know, I've got some local data open, and we're going to dive into some of that local data and kind of compare how some of the markets are working around the country in the second half of the day today. All right, let's start with pricing. Median home price in the US this week is up to 344,900. You can see in the dark red line on the chart, you see the seasonal rise and fall of pricing. And in the first and second quarter of the year, you get the best inventory, you get the most buyers, so you get the pricing strength each year. It peaks each year in July, and then typically starts to drift back down a little bit. Last year was a very unusual year in that normally you'd get your peak in June and end of June, July, and then third and fourth quarter are reliably ticking down as demand backs off. It's school, we try to do some price cuts to move the properties. We have that primary buying season has passed. Last year, we had our little dip in March and April. So this is the first lockdown of the pandemic. You can see how prices adjusted. And then starting mid-April, demand just skyrocketed. Prices held steady all the way through Thanksgiving and the holidays. And then of course, we reset every year the second week of January. So the new inventory for the country starts to come on the second week of January. You start to get things that were pulled over the holidays, they get relisted, and the market resets itself. Of course, we had a 10% price appreciation year over year in 2020. That was, you could see the, you know, 315 to 345, $30,000 year over year. And the indicators, all the leading indicators, all the supply and demand indicators are setting us up for yet another 10% price appreciation year this year. That's unprecedented. 10% 2 years in a row. There's a lot of implications for that. For example, your homeowners are gaining vast amounts of equity in these 2 years. That has implications for the properties that are in forbearance right now, and that those who have not been paying their mortgage because of, for example, they have maybe they went from 2 incomes to 1 income, and they all of a sudden couldn't afford their mortgage payment. They've been in that forbearance program, but while they have been in that state of not paying their mortgage, they've gained a lot of value on the house. The implications are, of course, that nobody who's got that much equity is going to go into foreclosure. They're going to either figure out how to resume paying their mortgage, or they are going to sell the property. A little more on that in a few slides. The green line on the chart here is one of the most powerful leading indicators that we have in the Altos research data. This is the price of the newly listed cohort. These are the properties as they come to market each week, and there's 100,000 new ones that come in. We look at the price of those 100,000. And what happens is the agents and sellers, the listing agents and sellers, do what we call in economics the wisdom of the crowds. They are the crowd that is very sensitive to all the local conditions. They're sensitive to how many buyers they have, how many multiple offers were down the street, how few the inventory, how over asking the last properties went. All of these signals allow the listing agents to price their next listing a little higher. And so you can see in the first and second quarter of the year, that number spikes as the new listings come on the market. We started January higher than we've ever started, and we are in a very steep appreciation. So this is one of the places where you see house gets listed in February, it gets an offer in March, it closes in April. That data starts coming through the traditional channels in May and June. So you're going to see sales prices be elevated all the way through. And so this is a leading indicator of the traditional data. And so we're at 450 right now. That's going to jump again next week. So all of the leading indicators pointing to that strong pricing year. So that's where we are with pricing. Let's move on to inventory. The inventory crisis that we are in. This is a 6-year chart of inventory cycles, active inventory of single-family homes for sale. You can see it was not that long ago when we had 1 million homes for sale at the beginning of the year. This is January 2016, February 2016, had almost 1 million homes. In 2015, there was well over 1 million. And each year, inventory is decreasing a little bit each year. The only year that inventory increased year over year was between 2018 and 2019, and that's when interest rates climbed, and I'll show you that in a sec. Last year, we started at 730, like we started the year at record low levels, and we are less than half of that available right now. The things to look at in this data each week from here is that normally we have a couple of weeks in February here where we start to see the inventory tick up week over week. That means because new properties are getting listed and they're starting to come to market. And then March, April, May is when we have our inventory normally climb. You can see last year, here's the 2 weeks of March before we started that first pandemic lockdown. And so that's the cycle that we should see. Like if we are lucky. Things are moving so fast that there are actually tens of thousands of homes that are essentially bypassing the active market altogether. They're going right into pending contract, getting multiple offers right away, being active on the market for essentially 0 days or maybe 1 or 2 days, and then going into contract. So, but if you walk into the market right now, like this is what you're going to see. You're going to see this. You're going to see 355,000 homes, and that's it. It's a crisis, and there's long-term reasons for this. You may have heard me say previously, the long-term, the decade-long reason that we are in this cycle is primarily because interest rates have been super low. In that last decade, we've also been underbuilding, but it's really a function of interest rates. When we look at the forecast, so we've revised our forecast of the inventory for the year. We've revised it down because January and February have been going so aggressively, so quickly. We're at 354,900 right now. If we're lucky, the end of February and March that starts climbing, we get a little more listings happening, which would normally peak sometime at the end of July, early August, but we get a little bit, and we probably about October before we maximize. If we're unlucky in terms of the buyers out there, meaning things are just going so fast and nothing's getting listed, and this continues to fall. Like there are scenarios where the crisis worsens from here, gets tougher from here. So this is the curve that we're looking at. So like, a few more, but we may top out at only 500,000 or so properties, on the market in the third quarter at the peak of our market this year. So that's what the forecast is looking like. Here's the interest rate chart. So over the last 10 years, from 2010 through now, the average 30-year mortgage rate's been 4%. And that, of course, is ultra low. And it means that it has been very affordable to have to own not just your primary residence, but an investment property. So the phenomenon is you move up to your next house, but you keep your first house as a rental income. And that's only accelerated in the last 2 years. So the peak recently was January 2019, and then it's just fallen since then. So you can imagine if you had a 4.8% mortgage a couple of years ago, and now you're going to buy a second house, you refinance at 2.7%. You could essentially have 2 mortgage payments for what you were used to be just recently paying for one. It's a really good time to own and really affordable. And in fact, even in the face of rising prices, payments are still falling with interest rates. So affordability has actually improved over the last year because rates have fallen so dramatically. Affordability, payments are low, demand is super high. The number that's important to remember is that in that 10 years from 2010 through now, we have moved 7 million homes from purchase inventory to rental inventory. And that is both a combination of individuals just doing one house at a time, but it's also institutions buying up homes for single family rental, and which really started in the heart of the last crisis in 2010, 2011, when the well-capitalized companies started buying out the distressed mortgages. The thing to note here is all of us in the industry asking ourselves, when does it end? When does it change? Is there a crash coming? All these questions can really are sensitive to interest rates. When we look at this stretch here from 2018, January, it was about April of 2018, the rates rose above the long-term average, above 4% to 4.8%, and demand significantly backed off in that time. And if you remember on our inventory chart, that January 2019 was the only time when we had more inventory. That's because it was less affordable at that moment to have 2 houses. So you sell the first one. Now all of a sudden it's super affordable to have 2 houses. You don't sell the first one. You buy the second one, don't sell the first one. And that's what's contributing to our inventory challenge right now. We have far more buyers than we do sellers. It's also when and if rates climb back up again, our expectation is that 4% threshold will be really noticeable. Now, if we stay below 3 for a long time and all of a sudden 3 feels expensive, you could imagine that might impact demand too. But really that 4% is a number that you could imagine that we have demand changing as rates climb to that point. When that happens, I don't have any idea. We really don't have any visibility to how or when rates might climb. We know that the stimulus and the economy is growing, like jobs are growing, and those elements are in place. Post-vaccine, like we may have, like there are some scenarios for a very strong economy this year. And if that's the case, you could understand that rates climb. And frankly, that feels to me like it would be healthy. Like a 10% year of home price growth and another 10% year, like all of a sudden the speculation and froth is in the market, and that's when bad things happen. And I'm going to show you a few signs of the froth right now. That's going to be like that is really fascinating. But before we go on to that current state, the other thing to keep in mind that is important for buyers and sellers to keep in mind. And I just had this conversation with a friend yesterday who is buying a second house, not selling the first house. And but he was, wondering, is this a smart long-term decision? And the long-term number that we talk about is millennial demand. The millennials are now rolling into their mid-30s. They are the biggest population cohort ever, bigger than the boomers. And they are entering their peak earning and home buying years. So long-term demand is in place. That is going to be important for you to know, and something that, while yes, this incredible boom has to subside, will subside, the long-term trend is also in favor of buyers right now. So if you have buyers worrying about that, that's an important factor to let them know. Millennial demand is really just starting and has a solid 5-10 years of growth behind it. Let's look at what this all translates into. As I mentioned recently, this is nationally, we're in a seller's market unlike any we've ever seen. Altos uses what we call the market action index. This is a measure that we defined as an algorithm, as a calculation that allows us to look at any local market at a glance and understand, how's the market? Is it hot? Buyer's opportunity, seller's opportunity? And it works like a speedometer. The higher that market, the higher that goes, the tighter the inventory and the greater supply, that number goes higher. You'll see on all of your Altos reports the market action index, and it's really handy to just point to clients and say, even if you're not into all the data, well, we have your house listed. I want you to keep your eye on this one number. While we're looking for homes, look that this is a strong seller's market. If we're going to make an offer, we need to make an offer now. So using that as a conversation point. And you can look at the chart above, the top chart here above. The little green line, the dotted line, is the weekly readings, and it goes up and it goes down. It goes down with holidays, and it goes up on the busy weeks. The bright red dotted line, this was that March and first week of April last year. We go into lockdown, demand stops for a few weeks, and then boom, it takes off again. We have that all that summer, it stayed hot through the fall in times when normally it would fall off. You could see Thanksgiving and then Christmas, New Year's. Here's what we've got here. Look at this demand that's skyrocketing. This is nationally, this is across all markets, all price points, through the roof, higher than we've ever seen. The dark red line here is the smooth line, and this is what you'll see down in the speedometer here, week to week. So what we're seeing is that this speedometer is going to keep climbing for the next week, months. We know that it's above, and anything above 30 are seller's market conditions. So we're very, very rarely seeing buyer's market conditions anywhere in the country right now. Even in places like New York and San Francisco, the buyer demand is there, the investor demand is there, that all of the elements are in place. If you blink, you might have missed the opportunity to buy in San Francisco, because it's universal. So and we'll show you some of that and some of the local data coming up. Here's another of the leading indicators. This is the percentage of homes on the market taking price reductions. This is another place where we are in unprecedented territory. Typically, the rule of thumb is about 35% of homes on the market take a price cut before they sell. This first couple of weeks in February is the low point of the year. typically. That's because we've got all the great new inventory is coming online. The buyers are there. And then what happens is those that were maybe overpriced and didn't sell, now they move into March and the price cuts start happening. When things are still on the market at the end of August, now we start taking more price cuts because we know we want to move it before the fall or before the holidays. So price cuts crescendo in November, right before Thanksgiving. Or like, let's see if we can move it before the holidays. This stretch here in 2018 was, you can see more price cuts started happening. And that's when rates went just from 3.8% to 4.8%. They went up not that much, but they did go to the highest they'd been in a long time. And you can see the price reductions because demand backed off. And when you see when the sellers see the demand back off, they start saying, oh, maybe we should take a price cut. So that's where you can actually see, and we started January of 2019 a little weaker, and then all of a sudden last year started super strong again. Well, we had crazy year. No price cuts had to happen when lockdown was happening, and all of a sudden demand is there. Demand never subsided last year. Demand usually subsides in the fourth quarter, did not subside. And then all of a sudden we got on our normal curve, and now we're at 19% price reductions. So if you think about it, think about the listings that you've had where a seller goes, well, let's see what we can get. And let's see if we overprice it. Some sellers will say, you know, if you didn't take at least one price cut, you underpriced your house. So a third, 35% think they're overpriced, and only 19% are taking a price cut. That's because we've got multiple offers, we've got overbidding, we've got all these pieces in place. That means that the homes that are on the market now, they're going to close at higher prices than before. So this is, again, another of the super bullish leading indicators. One of the things that tells us why we're going to have 10% at least price growth for the year this year. We're going to contrast that leading indicator with price increases. Price increases are the percentage of homes on the market that have increased their price in the last 90 days. That is typically, these are typically like investor properties, they're flips. They may be strategic relistings. So maybe you had a property on the market in December, it was at Christmas time, it didn't sell, you took it off the market for the holidays. Now it's 40 days later and you're relisting that property now. They're relisting at a higher price because we can see how many multiple offers are happening, how fast things are going. So all of a sudden, we are at almost 7% of the properties in the whole country are in price increase mode. And in some markets, it's like 19, 20%. It's really high. This is one of the areas where I think we need to keep our eye out for the bubble froth of the market, the scary parts of an ultra booming market. When we get in a situation where we have too much investor money chasing fast flips and increased and rising prices, like this can go on for a while, but these are the areas where it can be very like telling that we might be overextending this run. Then you can imagine investors, you get in a world where investors have a bunch of properties on their hands and rates rise and demand backs off, then you get a cycle, a bad cycle. This price increases is also likely a function of the iBuyers. These are Open Door and Zillow, and to a lesser extent, smaller companies that are making offers, buying the property right away, and then they resell it very quickly. So as the iBuyers gain market share in a hot market, you can expect this number to increase as well. But it shows unprecedented demand. It shows as a leading indicator for where transaction prices are going to be in 3-6 months. Like, it's very, very clear. Here's another indicator of investor activity. I borrowed this chart from my friends at John Burns Real Estate Consulting. They are looking at the total number of sales, percentage of sales where the buyer is in a different zip code. So these are investor sales. And you can see places like the Sun Belt, the Phoenix, Tampa, Houston, Austin's, San Antonio's, which often get, snowbird sales, investor sales, very high. New York has a lot of obviously international buyers, which is a function too of cheap money. So as investor activity gains, like that's another signal of like all of the elements that are going into demand right now. It's interesting. I was talking with a group of agents and brokers in LA this week, and a lot of the LA buyer demand, LA residents buying in places like Idaho, Boise, or Palm Springs this year, or Oregon, driving a lot of the demand out of California. But at the same time, LA and the Southern California markets are destination for New York residents. So you'll see that kind of investor activity going on as well. So just another indicator of we've got off the scale demand in a crazy tight market. When we're going to shift in a moment to the local data, we're going to look at some of the local reports. In your Altos reports, we do all of the data in price range segments. The high end of the market may be behaving very different from the low end. In this case, everything in the world is hot, but you can really see some powerful indicators. I grabbed this. I think this is Seattle, maybe. The days on market per price range. In under $500,000 in Seattle, the median days on market, meaning half of the stock, is going in essentially under a week, like 0 days, a day, a couple days, under a week. Now the $2 million properties take a little bit longer to sell, but even those are only going to 2 months. So that's a really important distinction, both for your listings, your sellers setting expectations, as well as your buyers. Like if you're buying at under $500,000 in Seattle right now, you need to be prepared for what's going to happen. And this is not isolated to Seattle, of course. You're sure of it in your local markets everywhere. So I'll show you that in the reports and how you can use that for framing your conversation. One of the most important things to keep in mind when we're talking with buyers and sellers this year is that, I've said this before on these webinars, but it's important, it bears repeating. Very often nurturing leads in the real estate business is about sending listing alerts. Hey, here's a new houses for sale in your zip code, in your price range. But what are you going to send when there's no listings? Well, the good news is that market data and your Altos market reports are always fresh and they're always compelling. In fact, they may be more compelling right now. In a time when there's no listings, there's no listing alerts, but there's always great market data. I want to run our poll. Each of these months, I've been running a poll that says that I am interested if you have talked to any potential sellers who are worried about their ability to make the payments. We are getting close to the end of the first year of the forbearance process. It was a 12-month process, and there were 350,000 properties scheduled to exit forbearance in February. There was another 650,000 scheduled to exit in March. That is potential inventory, but just this morning, the FHFA extended that initial forbearance window from 12 to 15 months. So that's likely going to extend our inventory crisis, even as it helps people who maybe went from 2 incomes to 1 income and still need to figure out how to get another job and be able to renegotiate that. The important message here is that that if somebody you are working with has been in forbearance, they're looking at coming out of forbearance and need to renegotiate their loan. But if they're never going to be able to make that payment again, like, it's a really good time to sell, and you want to do it before you miss a payment and are 30 days late, because then you can't get a new mortgage next time. You want to do it now, sell before you get in distress with that mortgage, so that you can then go take your equity and buy something else. So this is a little interesting. Okay, I'm going to end the poll here and share the results. There's still 80% of us who have not had that conversation with anyone in forbearance. 20%, that's up a couple percent from last month. And February and March are going to be really interesting windows on that, because now we're at a year of that first, like the first properties that went into forbearance. So 20% ticked up a little bit, a couple more percent this month. That's actually good to see. Okay, so as I mentioned, so 5 million went into forbearance. 2.7 million are still in that forbearance process right now. 350,000 are scheduled to exit forbearance at end of February, and another 650,000 due to exit end of March. It was just extended, though. That March deadline was all of a sudden 3 months out. So and the foreclosure moratorium has been extended through at least the end of March for occupied homes. The only ones going through right now are unoccupied, vacant properties, et cetera. So that's, it keeps extending. At some point, we've got to end it. And but all of the policy is aimed at keeping the people in their homes. It's aimed at helping that price, all aimed at an entirely different crisis from the one that we've been talking about today. The policy is aimed at the crisis of that temporary crisis of unemployment, displacement because of the pandemic. And what the other crisis that we're facing is this inventory crisis, and none of the policy has yet recognized that. Okay, let's do this. I'm going to share my switch over here. This is the Altos back end of the system. I've got a bunch of local reports up. So by the way, I'll give you a quick tour since I happen to have this open. In your Altos system, you have the opportunity to see the reports. I just happen to search for Boise. You can see who's reading those reports each week. You have your contacts that are coming in, new ones. How many of your campaigns and your contacts have been seeing those emails that are going out, putting that market report. So as I was mentioning, you have a listing alert that you're sending to your database. If there's no listings, especially if there's no listings in your price range, what are you going to send? Market data is what we send, and it gets very high open rates. And so I won't spend too much time on it right now, but that's how you get this data into your clients' hands every week. Here's California. So let's dive into some local. So California at a state level is a strong seller's market. It is because California is higher priced in general, like median price in California is 800 grand. You can see that the dynamic, and one of the things I like to point out today, we're going to look at the market action index and our price decrease and price increase dynamic. So in California in general tends to have has had chronic inventory shortage for 40 years since Prop 13 went into place. So because inventory is so much lower, price reductions are actually lower in California than they are commonly in other places. Like, for example, Phoenix is significantly higher in normal times. Price increases are fewer in California as well, meaning that fewer of the most aggressive, less of the most aggressive investor activity that's happening, and much more of the retain my first house, buy the second house, which is why long-term inventory is low in California. But you can see exactly where the demand is here. You know, the $3 million places, 100 days, the $600,000 places, 21 days. So that's California as a whole. You can see that dynamic. It's still crazy, crazy, crazy. Let's look at some of the hottest markets in the country: Denver, Boise, Seattle, Austin. Here's Denver. So Denver has only 16%. Denver, 80 on the market action index, like, is just about as high as you can go. 100 is the highest in the market. This is Denver, all of the Denver metro area. Median days on market's down to 21 days. Meaning half the properties are going faster than that. Price increases, so significantly more price increases in Denver than in California. So 10% price increases is pretty high, but you're going to see it's not the highest that we've got around the country right now. Here's what inventory looks like in Denver. Normally you get this normal great seasonal movement. Here's where we were last year at this time, and we've had this year little pandemic window, and then and so we are now 1,200 properties. Last year we're at 3,200, like 40% of where we were 2 years ago at 4,000, and we're down at 1,200 properties right now. Like, nothing on the market in Denver. And you can see at anything under 600 grand is going in a week. And this is a median days on market in the Denver area. This is really hard to communicate to buyers and sellers. Like, what does that mean? But it does mean, here's an interesting thing. If you're an agent and you are competing against iBuyers in a market like Denver, where the iBuyers are, the advantage of an iBuyer is that they say, hey, we can get this property done, we can get this thing sold in a couple days. You have to take a discount to do so. And so they underprice the house, so they underbid with the promise of moving it real quickly. In this market, it's moving real quickly and you don't have to take the discount. So as a listing agent, you have an advantage over the iBuyers, and it's really apparent in the data right now. Something to keep in mind. Let's look at Boise. Idaho may be the hottest place on the planet right now. 82 strong sellers market. Median days on market in Boise is 7 days. You can see the price decreases are 12%. So remember, this is a third of the homes that sell think they're going to take a price cut. Only 12% need to. Like, that is insane demand. We could see anything under $500,000, 0 days. That's essentially, getting offers and going right away. This is median, so half of them are getting offers and going in, a day or a couple days, essentially less than a week. That is moving so fast. And now you get this interesting dynamic, of course, that you've got some in the Boise area, some, $2 million homes, and it takes longer to sell a $2 million home. It's a different kind of buyer. They're still going vastly faster than they went before, but you can see what's going on there in Boise. And 86 homes for this is city of Boise. The only town is city of Boise. And again, a bunch of homes are going directly into contracts, so they actually bypass the active market altogether. Let's look at Seattle. In the Seattle area, you have Price decreases are at 13%. Price increases are only 6%. So that's a little healthier mix to me. We're at a 82 strong sellers market. You can see anything under 700, under $1 million is still 14 days. So these are, again, like that close in demand. And Seattle had, let's see if we can look at price decreases. And I'm just going to use this window. So during pandemic lockdown time, we had a little bit of price decrease happen, but our demand stayed hot through the fourth quarter. So normally price decreases. Here you go, November, you do your price cuts right in the first week of November. We're going to cut it. We're going to see if we can move it before the holidays. And here's our like never even got into buyer's territory, and so we're now at record low price decreases. We'll probably finish down here at 10 or 12%. It's like demand off the charts there. I was looking at Reno real quick, and then we'll switch over we'll go further east. Here's the interesting dynamic in Reno. This is price increases. So price decreases are low, just like everybody else, because as demand is, there people have multiple offers. Price increases, 19% of the properties have increased their price recently. So that's flips, that's iBuyers, that is investor opportunities, that's the marketing opportunities that were maybe lower over the holidays, and now they're like lower before the holidays. Now they're relisted and higher. This is city of Reno. So, you can see this trend. Normally it's 2%. Last year started, 5%. It was a hot year to begin the last year, 5% range. And all of a sudden we are just skyrocketing. This is long-term worrisome for me. It does not feel sustainable, and it feels like that we want to keep, like, that's something I want to keep our eye on to make sure that that activity doesn't like that. That's like, I am personally hoping we get a little higher mortgage rate, a little greater inventory, a few more transactions, a little bit less insane, I think would be a healthy transition, healthy place for the market. But let's look. Here's Austin. Austin's a 73 on the market action index. By the way, I had a client, a colleague the other day mentioned how they use market action index. They're an investment fund that buys properties. They buy distressed, they buy distressed mortgages, and they work those out. They may flip properties, and they went and back tested years of their sales, their property sales data, and correlated it with the market action index. And this is a New Jersey and Northeast based fund. What they noticed was when the properties that they ended up in a weak pricing model for, that they didn't profit as much with, they could very clearly see the market action index in around this balanced or into buyer's zone. And so they are now using the market action index as they price their investment properties. They go to market, they can use that to decide pricing zone, so they can time the days on market, like how long we want to try to list this thing to maximize and how long we want to get it out. So they're correlating that with the market action index. And it's a technique that you can use, especially if you are working with investor clients, or you're working with a fund, or you're working with people who have multiple properties, can use that to actually price it to make sure that they're not overpricing their property. It's going to stick around on the market too long. So you'll see price increases in Austin. Austin's had just unbelievable demand, price appreciation, especially a lot of California in-migration. And so spending $1 million if you're moving from LA to Austin is very easy. And so you can see exactly where the demand is happening. Anything under $1 million in Austin, moving super quickly. I happen to have Virginia Beach open for a broker client the other day. Virginia Beach is a 50, so this is a like a military market. It's a lower cost market, but here's how you measure price decreases. So normally in Virginia Beach, 38% price decreases, right? This is like what it said. This is a normal market, a normal healthy market. This time of year is a low part of the year, 27 or 26%, and all of a sudden this year we're down at 16. So like even a place like Virginia Beach is at this massive demand stage. And so for sellers, like that's an important thing to know. Like we can get the price for your property, it'll move quickly. And again, like especially if you're talking about competing with an iBuyer, that's very meaningful on that demand, that discount. In Tampa's at a 59 on the market action index. Here's Tampa. Tampa is a market where we are normally have greater inventory available, so your price decreases are higher. They're like 45% is not uncommon, and that's you have greater inventory per capita. You have more homes for sale for people. You have tighter demand. You have less demand, so you have this more investor activity. You have that kind of dynamic that goes on in Tampa. So in normal years, 30, 40, 45%. In a weak market in Tampa, when you see Tampa price reductions climbing over 50%, 55%, that's when you know that that is a weaker than normal condition. But all of a sudden in Tampa, we're down at 26%. Like everywhere we look, the market is in crazy zone. 21 days at the low end of Tampa, 28 days, et cetera. Minneapolis is a market that is, I think, getting a lot of investor interest. I hadn't noticed about it, but I think it was some folks at John Burns Real Estate Consulting pointed out that in the flip activity happening in Minneapolis. So this is city of Minneapolis, and you can see it in Minneapolis. This is February in Minneapolis. We're at 9% with price increase. 9% of the market has taken a price increase. The market is heating up in Minneapolis. So all of these elements are really quick. You'll see Minneapolis days on market fall as it warms up and we go into a much more robust market in, for example, like March, April, May. That'll fall even further. So that's some of the East Coast. What's the other one? Oh, I happen to have Sunnyvale open. That's the local market where our Altos headquarters is. The Sunnyvale is a town of over 100,000 people. It's only got 23 homes for sale. That's and as a result, they cost a couple $1 million for them. For what's interesting is for the 30 or 60 or 80 or 70 years old homes. So that's the whirlwind tour of the data today. I am going to go share back to my slides, and we will finish up our. We'll move to the end of our slides here and just do our quick summary. And here we go. Wrap it up. If you're in the business of communicating this data to your clients, come to Altos. You can get the ebook. It's free ebook, and it help you talk up through the data, learn the scripts on how to communicate the data. And if you want to be able to put that in the inbox with your clients, just book a demo with us and look at the local data in your market and see how it works and see how we can bring in your database and integrate with your CRM and get that information to your clients, because right now everybody needs to know what's going on. There are lots of people who want to be buyers. There's a lot of people who are afraid to be biased. So the information is the antidote to fear. And put the information in their inbox every week. As always, this video and our weekly videos are on our YouTube channel. I also each week have been sharing on Twitter the data and the charts and things. So if you want to share to your Twitter feed, follow me on Twitter to get that data, and you can just share that. That's because that little Twitter thread is really neat to be able to share the images, a chart. Here's what's happening to inventory, and that inventory that national inventory chart is so compelling that social media wise, people's eyes bug out when they see it. So you can follow me on Twitter and grab that, and feel free to reshare that. All right, that's the wrap up today. We're 4 minutes before the hour. We have the panelists, the team Altos is on the chat. If you've got any more questions, they'll post a few links in there if you want to grab, for example, the ebook, or you want to go over and book a demo with Altos. We'll stick around there. Connect with me, connect with us on YouTube and on Twitter, for example, so that we can be in touch, and we'll do more data next week. All right, everyone. Thanks.